Welcome to the Dev Journal. Today, we are exploring a strange paradox where our software capabilities are expanding at a lightning pace, while the physical world pushes back with crushing costs and orbital limits. We are seeing architectural leaps like Qwen3.6, meeting the hard reality of spacebound, computing, and volatile market valuations. First, we examine a massive shift in coding efficiency as the Qwen3.6-27 billion parameter model manages to outpace its much larger rivals. We will look at how this dense architecture is challenging the dominance of mixture of experts' designs, particularly when it comes to the logic required for agentic programming. We also have to address the growing unease at Apple as the company heads toward its next earnings report. Between whispered rumors of a major leadership transition and mixed sentiment from the street, the tech giant is navigating a period of significant consolidation that has everyone questioning the stability of its long-term roadmap.
Speaking of stability, I have been digging through the recent SpaceX registration statement, and it really throws cold water on the idea of profitable orbital data centers. The financial and thermal constraints are a nightmare, but before we get into space, let us examine the massive gains in Qwen3.6.
The leap to Qwen3.6-27 billion is remarkable. We are looking at a 77% relative improvement in skills bench average 5 scores. This massive jump suggests that dense architectures are not just keeping pace, but are actively shattering the performance ceiling we once thought belonged only to massive sparse mixture of experts' models. What stands out is how this model holds its own against industry heavyweights. By matching the performance of Claude 4.5 Opus on the Terminal Bench 2.0 Agentic benchmark, it signals a new era. We are seeing mid-sized open models capable of managing high-stakes autonomous coding tasks once reserved for much larger systems. It is a fundamental shift in how we think about scale and capability. With a native context window of 262,144 tokens, this model can digest entire code bases at once. For businesses, this means more reliable agents that understand the broader project narrative without losing their way in the technical weeds. This expanded capability ensures that the model does not lose its internal logic during long, multi-turn coding sessions. It is about creating a seamless experience where the artificial intelligence remains a helpful partner from the initial architectural sketch down to the very last line of code, regardless of the complexity or the length of the file.
While those benchmarks paint a rosy picture, the mechanical reality of the architecture tells a much more complicated story. The researchers used a hybrid architecture that incorporates gated delta net linear attention for 75% of the sublayers. This move achieves order and complexity for sequence scaling, which is how they manage those massive windows. I am looking closely at the implementation of YAR and scaling techniques, which theoretically extend that context window to over 1 million tokens, while the 77.2 score on Software Engineering Bench Verified is a solid step up from the previous 75.0. The actual utility of 1 million tokens depends on the thinking preservation mechanism. We should also mention multi-token prediction for speculative decoding, which increases throughput significantly. This architectural choice is specifically designed to increase speed for real-world applications. It is a clever way to squeeze more performance out of 27 billion parameters, without the overhead of a massive 397 billion parameter mixture of experts' design. It is one thing to have speed, but quite another too.
OpenAI has just released a new tool called Euphony under the Apache 2.0 license. It is a powerful visualization platform designed specifically for managing the complex and often nested JavaScript object notation logs generated by Harmony and Codex artificial intelligence sessions. This move represents a significant commitment to the open source community. For teams working with advanced models like GPT-OS 2026, this is a game changer for debugging. It allows developers to render multi-channel outputs, including internal reasoning chains and specific tool calls, directly within a structured user interface. Seeing how an agent actually arrives at a conclusion makes the entire process much more transparent. The inclusion of a focus mode helps teams filter messages by role, which is essential when dealing with massive datasets. There is even a grid view that supports manual scoring and labeling. This allows developers to turn raw data into high-quality datasets that can be used to further refine the performance of their custom models.
If you look past the slick interface, the security implications of the underlying architecture are quite concerning. The tool relies on a fast application programming interface backend written in Python to handle remote data loading. OpenAI has issued an explicit warning regarding potential server-side request forgery risks if that backend is ever exposed. Looking at the codebase, it is approximately 78.7% TypeScript, which provides some welcome type safety for the front end. However, the heavy lifting happens via James path-based filtering. This allows for incredibly complex queries across large datasets, but it requires a deep understanding of the query language to be truly effective for engineers. One interesting design choice is that Euphony can be exported as a reusable custom element. This means it can be plugged directly into existing internal dashboards built on React, Svelte, or Vue. It is a highly modular approach, though the requirement for a separate Python backend adds a layer of deployment complexity that many might find frustrating. Ultimately, this tool is a response to the sheer volume of telemetry these modern models produce. When you are dealing with thousands of nested calls, standard text logs are completely useless. Euphony provides the necessary structure to parse those logs, provided you have the infrastructure to host it securely within an isolated network environment.
We can see that managing the software layer for these models is becoming a massive task in its own right. But the conversation changes entirely when you move from the software layer to the massive physical infrastructure challenges of hosting these models in orbit, as we look at the latest filings from SpaceX. The recent filing from SpaceX paints a sobering picture of our orbital future, admitting that interplanetary industrialization and space-based artificial intelligence compute are still in their infancy. While the vision is grand, the technical complexity mentioned in the document suggests we are much further away from a functional orbital backbone than marketing suggests. To reach a gigawatt scale for these data centers, we would need solar arrays 10,000 times larger than the ones currently powering the International Space Station. That is an area equivalent to 5,000 football pitches floating in orbit. It makes the $8.4 billion raised by Orbital Changguang look like a minor down payment. Even with those daunting numbers, hardware leaders are placing their bets on this extraterrestrial shift. NVIDIA has already announced their Space One Vera Rubin module to support large-scale inference and edge intelligence. They see this as a necessary path to bypass the land use restrictions and atmospheric cooling limits that are currently choking terrestrial data center growth.
I have to wonder if the people planning these facilities have forgotten basic thermodynamics. In the vacuum of space, you lose the luxury of conduction or convection for cooling. You are left entirely with radiation, which requires massive radiator fins that create a nightmare for structural integrity and station keeping when you are dealing with gigawatt-level heat. Beyond the heat, there is the threat of radiation-induced bit flipping caused by stray gamma rays hitting binary systems. Terrestrial centers do not pay a reliability tax of this magnitude. When hardware is failing because of cosmic rays, the cost of error correction and redundant systems starts to eat away at any potential efficiency gains. The economics are as punishing as the physics when looking at cargo rates. Launching heavy hardware costs approximately $1,400 per kilogram on a Falcon Heavy, while National Aeronautics and Space Administration estimates reach $2,940. Moving enough server racks into orbit requires a staggering amount of capital. We also have to listen to experts like Professor Olivier de Week from the Massachusetts Institute of Technology, who argues these timelines are pure fantasy. Constructing gigawatt-scale solar infrastructure cannot happen within the 1 to 3 year window industry leaders are claiming. The logistics of assembling such massive structures in zero gravity are currently beyond our proven capabilities.
While the physical costs of building in the stars are enough to ground any project, the financial gravity on Earth is just as intense. We need to move from the structural challenges of orbital infrastructure to the intense market pressure and financial volatility facing the massive technology giants who are expected to fund these ambitious new eras. Moving from the cold vacuum of space back to the intense heat of Wall Street, we have to look at the $4.02 trillion weight of Apple. Investors are holding their breath as rumors of a chief executive officer transition swirl, threatening a potential price swing of 5% or more. While the company sits on a mountain of cash with nearly $98.77 billion in free cash flow, the sheer scale of the organization makes any leadership change a high-stakes gamble. We are seeing 67% mixed sentiment across the market as people weigh the risks involved. That level of uncertainty is especially sharp when you consider the price-to-earnings ratio is currently sitting at 34.53. Even with a staggering return on equity of 152%, institutional sellers like West Hill Financial Advisors are beginning to trim their heavy positions lately. The market is clearly bracing for the April 30th earnings report, searching for any sign of cracks in that $4 trillion armor. Vance, when you look beneath these massive headline numbers at the actual liquidity and momentum, does the underlying engineering of their balance sheet still hold up for you?
If you look at the plumbing of their finances, there are definitely reasons to pause. The relative strength index is currently at 67.06, which is perilously close to overbought territory. This suggests the stock is already stretched thin before we even hear the first word of earnings. My concern deepens when looking at the current ratio, which has dipped to 0.89. This indicates that their short-term assets do not fully cover their immediate liabilities. While their gross margin is healthy at 46.91%, that liquidity gap creates a narrow path forward. We are looking at a 5-day sideways price prediction holding steady at $273.17. Despite a bullish analyst price target near $297, the technical indicators suggest we are entering a phase of consolidation rather than a breakout toward those record heights. Maintaining that high price stability is a challenge Apple knows well, but the narrative shifts entirely when we turn to the electric vehicle sector. We must move from the stable but expensive valuation of the iPhone maker to the extreme volatility and margin compression currently defining the story at Tesla.
Tesla is heading into its April 22nd, 2026 earnings report with a narrative that feels split between today's production struggles and tomorrow's autonomous dreams, especially as the long-term story is being propped up by the projected launch of their robotaxi fleet in the first half of that same year. Analysts are still maintaining an average price target of $415.81, which is partly fueled by the recent full self-driving approval in the Netherlands, suggesting the company is successfully pivoting from a simple hardware manufacturer into a high-margin recurring revenue platform for transportation. Even with a mixed sentiment of 57% across the market, the broader investment community seems to be holding its breath for a breakthrough that justifies its massive scale during this transition from selling cars to selling the sophisticated intelligence that will eventually drive the entire business model.
Turning our attention to the cold reality of the balance sheet reveals a much more concerning picture of operational health, given the massive 46.79% year-over-year earnings decline, alongside a revenue drop of nearly 2.93% for the first quarter. The most alarming metric is the compression of their net margins down to just 4.00%, while their gross margin stays at 18.03%, indicating that the costs of operating their massive infrastructure and research are eating away almost every dollar of profit generated. Investors are currently paying a staggering trailing price-to-earnings ratio of 358.81 for a company with shrinking profits, which is the primary reason why the analysts at the Swiss banking giant downgraded the stock to neutral with a price target of $352. With a high beta of 1.92, the stock is twice as volatile as the broader market, and the relative strength index of 52.68 shows a neutral stance that provides very little cushion if the upcoming financial results confirm this downward trend in efficiency. While Tesla faces a massive valuation gap between its current earnings and its stock price, that disconnect is only a preview of the even more extreme valuation problems we are seeing in the quantum computing sector as we turn our focus toward the latest funding catalysts at Xanadu Quantum Technologies.
The sheer ambition at Xanadu Quantum Technologies is truly breathtaking when you look at the strategic support they are securing from the highest levels of government. They are currently negotiating a $390 million Canadian dollar package for Project Optimism, which signals a massive vote of confidence in their specific approach to photonic hardware. This funding is not just a line item on a balance sheet, but a foundational tailwind that allows them to push toward fault-tolerant quantum operations by 2028. By focusing on light-based computing, they are carving out a unique position in a field that many nations see as a matter of national security. Even with the typical volatility of a recent special-purpose acquisition company merger that added $302 million to their coffers, the long-term vision remains incredibly compelling. They are effectively building the infrastructure for a future that does not yet exist, while capturing the imagination of institutional investors who see the potential for a paradigm shift. It is easy to get swept up in the narrative of a quantum revolution, but I wonder if the current price tag on that dream is starting to defy the laws of fiscal gravity. Vance, can the math on this kind of speculative growth actually hold up when we look at the underlying hardware costs and the current revenue stream?
Calling it a price tag is quite an understatement when you consider the company has reached a market capitalization of $11.8 billion. This valuation is supported by a trailing revenue of only $4.62 million, which creates a disconnect so wide it is difficult to find a historical comparison for this level of exuberance. The technical indicators are screaming for a correction, with a 14-day relative strength index sitting at 78.02, which is deep into overbought territory. We are looking at a stock that has outpaced its reality so significantly that even the most optimistic projections for 2028 struggle to justify the price for new investors. There is a glaring alarm bell in the divergence between their gross margin of 92.18% and a net margin of negative 1,530.58%. This highlights that while the core technology is efficient, the research costs are punishing, leading to negative net income of $70.67 million, with negative free cash flow of $76.91 million. Xanadu is a stark reminder of the risks inherent in deep technology. These extreme financial metrics reflect the high risk and high reward nature of the technologies discussed today, where the promise of a quantum future must eventually reconcile with the cold reality of a balance sheet. When a 27 billion parameter model like Qwen3.6 outperforms a 397 billion parameter mixture of experts, it proves architecture wins over scale. Yet we see Tesla heading into earnings with high beta risks, reminding us that even the most innovative engineering cannot escape the gravitational pull of market volatility.
Vance, you have pointed out a recurring theme where the brilliance of software must eventually pay the rent to the physical world. We are witnessing a moment where the genius of algorithmic efficiency is constantly fighting against the physical limits of hardware and the unforgiving expectations of a market that demands immediate returns on speculative quantum dreams. Whether the industry is navigating leadership transitions at Apple or the cold vacuum of Orbital, computing the challenge remains the same. Balancing the horizon of what is possible with the math of what is sustainable is the great work of our era. Thank you for spending your time with us today, and we look forward to the next shift.